Okay, week 2, chapter 2, types, or we can also say styles of investing. We are going to go deeper and deeper into the world of investing in this week, and we want to kind of know what the possibilities are. What are other people doing? What is investing all about? What sort of strategies can I make for myself? Where do I fit in sort of the types of investors that you generally find? And how can I just get that finance, my personal finance and my portfolio, how can I tweak that to such a degree that it may actually see some growth? So slides and browser and some perspectives, the usual structure. Let's just jump straight in. And where are we now? Week 2, chapter 2, as mentioned, and slowly we progress, and hopefully you guys are learning more and more. Next chapter is also great, where we're going to look at some heavy hitters in the industry. Now, about investing, there is this general three types that you can sort of box yourself in. But before we look at this, I want to already highlight something that I've just come to realize as an important thing when it comes to investing and trading, is you kind of don't want to label yourself. And I guess that's true for many things in life. I personally think the more you label yourself, the more you limit yourself, because life is fluid, we are fluid, markets are fluid, so we kind of want to maintain a fluid attitude, if you know what I mean. And this goes for trading versus investing, for example. I mentioned that before, that there are moments where maybe you want to act as a trader, and there are moments where maybe you want to take some higher time frame or longer time horizon positions, where you start to enter the domain of investing more and more. And I'm doing that myself all the time, where yes, I kind of make a trade, but it's mainly a tweak of a portfolio, or it's something in my portfolio my portfolio is steady and I see a huge opportunity that I just want to capitalize on for the duration of like maybe 4 hours, or sometimes it's even like 15 minutes, right? When I'm really actively trading, one of the things that I'm good at is very short-term time frame price action trading. Because over the years, after looking at price charts mainly for literally thousands of hours, I've become quite good at recognizing patterns and price behavior and buy and sellers behavior in that sense. So there are times when I put on my trading suit, but there are also times when I just want to put on my investing suit. So why am I saying this? Because, well, there are mainly 3 types, as I said: growth, value, and income. Growth, generally speaking, has a higher risk, but also potential higher return. So we're talking about growth stocks, for example, where we have a small market cap stock that sees potential, like large potential future growth. So think of companies in their early days that you can invest in. Obviously, when you invest in something when it's still early stage, the risk of a company not succeeding, or a project not succeeding, or in blockchain, a protocol not succeeding, is higher than when it's already established. Now, when something is a bit more established, we can look at something called value investing. So there is already a proven value to a business. So let's say that you're new to the stock market and you are going to select a few companies. If we were to look at, for example, Apple, Amazon, Tesla, Tesla less than Apple and Amazon perhaps, because it's been around for not as long, that would fall more into the domain of value investing. So you kind of are placing a safe bet, hence the lower risk. There's more established track record already in a company or a protocol. So for example, if you take it in the world of cryptocurrency, you can say that, okay, if I place my money into Bitcoin, that could be value investing relative to, say, the newest project that just was launched and promises to be better than Bitcoin, right? That would fall more into the category of growth. So we are playing around with that sort of thinking and this sort of framework, where we have several stocks or just several assets that have a different risk attached to them, and potentially different growth scenarios for the future as well. So value investing potentially lower returns because something is already established. I talked about that before. When a company is already supplying products to the entire planet, you can ask yourself, how much growth is there still left? I'm not saying that there's no growth left, but there is potentially lower growth ahead in the next 10, 20 years than the latest AI company who is revolutionizing internet, blockchain, and everything, right? The potential for growth there may be multiples bigger than something that has already been established for like 20 years. And that's just something that we need to think about. Generally, value investing, Warren Buffett is, I guess, one of the main examples for this. It's taking, finding value in a business or a protocol in more modern times, perhaps, and making a prospect for what the future is going to look like. Placing your bets, finding value, and really having that long time horizon to see that potential value also come to fruition, right? If generally those high returns, you only get that with a lot of time as well. So it always seems like, quite easy to people that made these tremendous returns, but holding an asset for multiple years is really quite difficult, especially like a single asset. I'm not talking about index investing right here. Okay, last one, income investing. So generally the lowest risk, I would say, just depending on how you look at it. This is a simplistic example, but I think it is accurate. Lowest risk, but potentially lowest return. So for example, this would be bonds, but it can also be choosing a stock that pays out a dividend, right? Something that sees steady growth, pays out a dividend, and therefore you're kind of like, it's not passive. I don't necessarily like the term passive income because I think it's hardly ever passive. Of course, there are exceptions, but I know that many people are looking for passive income, and for that reason, I want to first start with the fact that you need some activity before. Anyway, I'm digressing. But income investing may very well be an excellent addition to your portfolio, where you have like a certain percentage of your portfolio, in safer assets that pay out a dividend, where that at least structurally you have some guarantee of making profits. Okay. So this brings me to a point where this game is all about creativity, and this is also why it's so awesome. It is very personal, so everybody has has a different risk tolerance, a risk preference, and people just like different assets, different styles of investing, and that's what makes it great. And now I'm coming back to knowing all the assets that you can select from. That's when you can get creative, where a certain scenario in the world brings it to a point where you say like, okay, now I'm gonna use this instrument to capitalize on that, or to protect my portfolio from downside, I use this in this instrument, okay? So yeah, active portfolio management, that's what we're working towards. Also next chapter, of course, we're gonna highlight that more and more. And risk management we'll come back to extensively, but this is, obviously of paramount importance. Your risk management and your risk tolerance, that is, allows you to sort of like tweak the knobs of your portfolio. Now, portfolio construction we'll look at more and more. I've just given a very, very simplistic example of how you could think of a potential portfolio. In one of the sources, I'll get to that in a second, we have a very famous portfolio. But let's say that you have $1,000 and then you just want to split it, right? Diversification, very important term, is spreading the risk over several assets so that you don't put all your eggs in one basket and that when things go south, you lose all your money. Generally speaking, that's very bad practice. There are exceptions. There may be moments where everything aligns and you actually could place like 80% of your capital in one asset, but that generally, requires you to be very knowledgeable of what you're doing and having a very high conviction into something really happening. So there's no right or wrong. I would definitely, encourage you to explore that for yourself. There are scenarios where you just want to take a lot of risk, right? When it's sort of like, warranted, if you will. Like it's okay to do so. If everything aligns and you see a huge opportunity, I think in the words of Stan Druckenmiller, you cannot own enough of it. Right, and that goes against the general textbook where you say like spread your risk, diversification, and then sit on your hands for the next 20 years. An exception to that, I should have turned the camera, giving you some perspective here, but like an exception, I was going to say something. I will come back to this. It will come back. I lost my train of thought there for a second. Anyway, let's get back to this. So let's, for example, say that you have $1,000 or $100, whatever your starting balance is, doesn't matter. 20% stocks, and then you can, for example, say 10% in dividend stocks, where I can I get a steady return in dividend over time, and 10% I dedicate to the proven companies, the blue chips, right? The companies that everybody knows, that have a solid track record, that have low risk of actually making huge downturns. Although Facebook recently, when they rebranded to Meta, they have had quite a downturn. But that's, for example, could be a safe bet for 20% of your portfolio. I would always recommend to have some cash on hand. Even in your investment portfolio, dedicate some money to cash, because if you have an extreme scenario where prices really come down hard, you want to have some ammunition. Please take that from me. When markets turn down and it's in a bear market and the sentiment is absolutely atrocious, when you have cash on hand, you're going to feel like a king or a queen, right? You're going to be sitting there with that cash, and you're going to, like, well, let's see how low we go. I'm going to buy I'm going to try to buy at a great area. If you don't have cash, you just have your investment portfolio fully invested and you see it go down, and that's very painful. You can get sleepless nights. It's not fun. It increases the levels of stress. But when you have some cash on hand, at least you can allocate some more, and in that way again to turn these knobs. Exchange traded funds. So a basket of security that trades on an exchange just like a stock does. So it's an asset on its own, but it's sort of tracking. It could be, for example, a collection of other stocks. So there is, for example, an emerging market ETF. So if you believe that emerging markets are going to be the next hot thing for the next 5 years, you can allocate, for example, 20% of your portfolio to an ETF that tracks that. So you don't have to do the research into all the individual stocks within the sector of emerging markets, but you actually just buy the ETF, and if emerging markets really, that sector flourishes, then that ETF will flourish too. And in that way you can profit from, for example, an ETF. It can be an AI ETF, can be like ARK Invest, for example, has a famous one, the ARK Innovation ETF. They have one of their biggest positions there is Tesla, but there's also some I think Coinbase is in there. So you have some AI, you have some autonomous driving, autonomous vehicles, cryptocurrency related, and then they have this basket, right? They have a collection of assets within this ETF. So you don't have to maybe dive into Tesla, blockchain, etc. But you may think that, okay, well, I think there is growth in that sector for the next 10, 20 years. So this is your way of getting exposure to that. Now, for example, 20% cryptocurrency, high risk, very, very high risk asset still. But, you can allow for your portfolio, at least part of your portfolio, to have, a higher risk tolerance. 20% commodities. So I don't know, let's buy some gold as well, golden, earrings, or a gold bar if you can afford it, and place it in a safe somewhere. So maybe 10%. Well, I think with $1,000 you can buy it like a gold bar. But if you could, for example, choose to decide, okay, 20% commodities, of which I do 10% physical, I store them in a safe somewhere, and 10% again, I buy an ETF to track commodities. So I was looking at the uranium ETF, for example. I'm not an investor, I don't have that, but I was looking at it as a potential interesting vehicle for the next, 5 to 10 years or something. So this is just one example, and I hope I'm giving my thought process as to how you can structure this, and how really the creativity here is limitless, right? You're only limited by, well, basically by nothing. Your creativity isn't limited. You can go as adventurous as you want. And of course you can switch that around, right? If your conviction at a certain moment in crypto is very high, switch it to 50% and then restructure the other stuff. Or, that's entirely, personal preference. I still have lost my train of thought of what I wanted to say before. Anyway, maybe we'll come back to that. Otherwise, I'll probably think of it, when I leave the room, and then we'll do it in the lecture. Perspectives. Well, why don't we first go to the browser, actually? Yeah. So, Investopedia, again, the usual suspect. One thing I wanted to highlight from this source is the entire idea of speculation versus investing. This is actually this was my point that I wanted to make. The more you are knowledgeable of a market or an asset, or you have mastered a certain trading technique, you have found edge or alpha, the more you can really take this stance of taking a lot of risk and actually, getting to that stage where you can't own enough of a certain asset. And this, this is closely related to speculating and investing as well. Generally, speculation is seen as gambling. The word comes from actually just to observe. And in that sense, we're sort of like all speculators, but generally it has got like this connotation of being a gambler. Now, investing and trading, if you are not the less experience you have, and the more it is close to, especially trading. If you enter that arena with zero experience, that's when you're close to gambling. You kind of don't know what you're doing, and it's either up or down. So, basically you are, it's not entirely like a correct analogy because the cards are not necessarily stacked against you like in the casino. So the more experience you have, the more you can really step away from this whole gambling factor. And this goes for trading as well. The better you get, the more edge you will develop, and the more money you will, the more money you will be able to make. Okay, so just that on speculation. So just read through this. Stocks, bonds, investment trusts. Yeah, I just want you to get to familiarize with all these all these types of investing. Just again, like making sense of the landscape that is ahead of us. Another thing, venture versus stocks and real estate. This is a very interesting article. So this is from AngelList. Remember the guy Naval Ravikant that I mentioned? And I'm going to round up after this. I will try to keep it short again. But like venture capital is really, like I said, an industry on its own. And if you can get into this direction, that is absolutely amazing. It's just like the earliest stage investing where somebody comes with an idea and you give them the money, and it's obviously very high risk. They very often is like the VCs that invest in 50 projects, maybe 45 go bust, 3 are mediocre, and 2 are are decent, of which 1 actually explodes, and that has like the 100 or 200x or maybe 1000x return, and that makes up for all the other ones that were bad. That's sort of like how this game is played. So a lot of diversification when it comes to startups, so startup investing. But the returns, if you do that right, obviously the people who were early in Twitter, Google, Facebook, I don't know, all those companies, Ethereum, for example. Peter Thiel, if I remember correctly, gave Vitalik Buterin, the creator of Ethereum blockchain, $100,000 to work with his idea. Imagine doing that, right? That's a little bit different than buying Ethereum at $5 or whatever. He's probably sold that to us. Anyway, cool story that was. Okay, so venture capital is important to understand. Recommendation for a podcast is the All In podcast. They only talk about not only talk about this stuff, but they talk a lot about venture capital, and they're all millionaire buddies, and they have very interesting and fun conversations. Very, very good to listen to those smart individuals. So portfolio management, we have a couple of sources here. I talked about that already a little bit, right? So let's leave this for this. Portfolio manage, I think, speak for itself. That requires some research on your end to see what works for you, to see how that goes, how you can tweak your the knobs, and how you can use that to your advantage. The difference between trading and investing, if I haven't highlighted it enough yet already, these are some basics in, again, the Plain Bagel, decent source, I would say, good source, and just to get that perspective in between. But again, fluidity, people, really. And I think if you spend a lot of time learning about investing, but also trading, you can really play around. You start to become like, like you're sitting there with your capital and it's like, okay, I can do this there, I can do this there, and this there, and this there. And over time, I promise you, you will outperform the benchmark. It's really, really possible. Don't let anybody tell you otherwise. Okay, Ray Dalio, another heavy hitter, the all-weather portfolio. So again, a good source. And it's just interesting to know about how an all-weather portfolio is structured. So one thing that I didn't do in the slides, for example, is incorporate bonds, right? That's generally not very accessible to the average investor. Also not that interesting if you're working with a few $100s. That gets more interesting if you get to larger amounts of capital. But it's important to know what this all-weather portfolio is because it is quite famous. Ray Dalio is super famous, and I want you to get familiar with his work as well. Speaking of bonds, Bill Gross, the Bond King labeled. I hadn't heard of him actually, to be completely frank, before selecting the sources. But then I dove in, and then it's like, okay, wow, this is really cool. And this is the same as like Bill Ackman. These guys make trades where you just think like, how can you see that opportunity, right? Like, how do you do that? It's just absolutely fascinating to see. So there are some examples in the podcast. This is the advanced source, so not mandatory. This does go a little bit deeper, But since we can't spend that much time on bonds and on each individual topic, this is your way into getting a little bit more to know more about the bond market. Okay, so I think I'm not sure how long. 20 minutes. Okay, I think that's still sort of acceptable. I'm going to round up within the next 50 seconds. I think I've given some perspective already. This game is really about creativity, and the more you have these tools in your tool belt, the more creative you can get, and that allows you to spot opportunities that other people simply do not spot. There's people that didn't spend that much time to learn about this stuff, to really, see how market dynamics work, what you can invest in, where you can put your capital. Because I'm not going to round up because I wanted to give one more example actually, and it allows you to capitalize on events that happen in the world, right? COVID is a good example where, yes, there was total panic and a market crash, but there were stocks that actually performed ultra well. For example, Netflix and Zoom, right? Where you get into the situation where everybody's locked inside their homes, but businesses need to keep on going, right? So Zoom calls were all of a sudden like they exploded, the stock exploded. And that's a way to, if you can capitalize on that. So instead of, for example, the 20% cash would be at that moment excellent to allocate to something like Zoom or Netflix, because I was one of the people, for example, that expanded their Netflix account to a family account because, well, the entire family was at home, and why not, all watch sort of, well, you didn't watch Netflix all the time, and I'm sure many people, many other people did that as well. And so that's a way of like, okay, you have this market instrument at your disposal, you know your way around it, you know how to allocate your capital, where to allocate your capital, and what instruments to use. And in that sense, you are becoming a master of your money, right? You're actually working with your capital to protect yourself from this, annoying inflation, and you actually, capitalize on opportunities. I think that's more than enough, because this is getting quite lengthy. 22 minutes, and yeah, we'll see each other in the next one where we are going to look at strategies. We'll look at more and more strategies also in the lectures, and we'll talk about this in Discord plenty. And we're going to look at, copying the grades. Should be fun.